We know there's a boom in the ETF market. More than 1,000 new ETFs listed last year in the States. Our guest thinks this trend will continue. Aniket Ullal joins us, Senior Vice President and Head of ETF Research and Analytics at CFRA. Aniket, thank you very much indeed for joining us.
Thank you for having me.
What trends jumped out for you with ETF issuing in the States last year? I know we got a whole bunch of new product categories.
Yeah, you're absolutely right. It was a very good year for ETF investors and the industry, both in terms of flows and returns. We had over 1,100 new ETFs launched in the US. And as you mentioned, we had a couple of new interesting categories. One was auto-callable ETFs. These are essentially an ETF of notes that offer higher yield than traditional bond instruments, although there are some caveats and probably are more designed for a sideways market. We saw money market funds, 2A7 compliant money market fund ETFs launch in the US, as well as multi-coin crypto ETFs. So we've seen now in the US, the ETF ecosystem expanding from traditional low-cost beta indexing to these newer categories. Not that low-cost beta indexing is going anywhere, it's still around, but we're certainly seeing a lot of innovation in new pockets.
Tell us about a couple of these auto-callable ETFs. Can you remind me what they are, please?
Sure. So these are notes that offer higher yields in traditional bonds. They pay out a high coupon unless they hit a certain threshold. So there are certain asset thresholds. If it falls below that threshold, the notes don't pay out anymore. But if they stay within a certain range, investors get a higher yield. And these ETFs essentially hold a combination or a series of these ETFs, of these notes. So investors don't need to keep rolling from one into the other. So it's essentially a laddered exposure to auto-callable notes. So you can think of it as another way to get access to derivative income, through an ETF vehicle.
Derivative income. Okay. You have some ideas for us. Let's start off with one financial ETF that you think may offer promise for investors, and that's the Invesco KBW Bank ETF, KBWB. That one down today. The market is weak, but it's had a good run over the past year. What has this one going for it?
I think the primary thing is we've seen now most of the big banks reporting already the Q4 earnings. They've had pretty strong earnings. This is really a story of fee income. We've seen our fundamental analysts, of course, look very closely at bank stocks. And we're seeing a lot of resilience in fee income, whether it's on the capital market side with M&A transactions, as well as on the wealth management side with the markets being up. As you mentioned, we have a slight pull down today. But more broadly, we've seen a lot of asset growth. And that's certainly positive, both for the wealth management business as well as trading activity on the capital market side. So it's really a fee income story for banks in the US.
Do you have another one? The Schwab Fundamental Emerging Markets Large Company ETX, the symbol FNDE. Let's have a look at how that one has been doing. What's the advantage? And for one thing, we've seen money go into South Korea and China, you say, as of last year anyway.
Absolutely. And, we talk a lot about the AI trade in the US, and of course, US equity markets were strong in 2025, but actually were underperformed relative to a lot of emerging markets. So a big driver here is the weak dollar, particularly with, pressure to lower rates in the US. We think a weak dollar is probably here to stay. That helps emerging markets. And certain markets have had, their own individual drivers. Certainly in China, we've seen exports being strong. Despite tariffs in Korea, we've seen semiconductors drive a lot of returns. And so we think emerging markets could have another good year in 2026, which should help an ETF like FNDE.
And then finally, Vanek Pharmaceuticals. The symbol is PPH. Is this all about growth in those semaglutide drugs?
That's certainly a big driver. The biggest holding here is Lilly, which of course is a big player in that space. But more broadly, it's a story about how pharmaceuticals has certainly turned around in the last 6 months. We've seen some of these companies make deals with the US government where they've agreed to offer most favored nation or MFN pricing to Medicaid in exchange for some tariff predictability and relief. And certainly we think that's a big part of the story. Healthcare is a sector which in October we upgraded from negative to market weight. And within healthcare, we like the pharmaceuticals and biotech sector. So we think this is an ETF that, again, we have a high rating on right now.
Thanks very much indeed, Aniket. Really appreciate it.
Thank you.
Aniket Ullal, Senior Vice President and Head of ETF Research and Analytics at CFRA.